All right, everybody. We are here today with a really special event here at Geo. I'm doing this for Geo as well as the my Substack, which is ms.cliffnotes.substack. And really, I've been wanting to do a kind of quant partnership with some quant investors for a long time. And I thought now would be a great time to do it during this market turmoil. And what better time to launch something new? So we're here today with two individuals I've kind of come through to meet through Twitter or through X. We have Dr. Andreas Hammerreich. Is that right?
Hammerreich, yeah, Himmelreich.
Okay.
Yes.
My best German impression. And we got Curtis Hammerling, which I think this is how the conversation started. I was talking to Curtis. So, basically to set things up before I go into the disclaimers in terms of conditions of Geo, really, I'm trying to find ways to merge our kind of Geos and then on the Substack, the index that we created there, which is 110 stocks now, which is quality smaller cap companies going through multi-bagger kind of factors, or you want to call them, how to maybe further extract alpha out of that index and out of GeoBest's model portfolios, while at the same time maybe reducing risk, or potentially even if we were able to not get as much alpha, but still get alpha and still maintain, healthy risk levels too. But from what you guys showed me, it looks like potentially we could maintain a lot of the alpha or maybe even increase alpha while actually reducing volatility or being able to kind of manage risk better. So I'm excited about this. I mean, I've talked to Ryan Telford in the past, that kind of got my kind of quant juices going
Yeah.
a little bit. So let's get into our terms and conditions really quick.
This discussion is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. This is not a recommendation to trade, buy, or sell any companies discussed. We recommend you consult with a professional investment advisor before transacting in any securities mentioned in this discussion. By viewing or listening to this event, you agree to the terms and conditions, which you can view in full at msmicrocaps.com.
And that's just to say too, whatever, Andreas and Curtis talks today about also is not investment advice. They're just offering their opinions. So don't take it that way. You get your own quant investor to help you out a little bit. So great. So let's start this out by going into the backgrounds of you guys. I mean, I think you're active on Portfolio 123. You do a lot of tweeting or a lot of posts on X, and I think it'll help. You have some really good rich backgrounds here to really, I think, get us excited about working with you. So, and I think our members will appreciate that. So, Andreas, why don't you go first? Tell us about what you've been doing, your whole journey, how you got to where you got, and then we'll do the same thing with you, Curtis.
Yeah, sure. Andreas, my name. 55 years old, father of two, married, living in Germany. I actually started out with studying economics and business in Germany, in Kassel, a little bit in London, Kingston University. And 96, I was ready, and I went into IT, basically IT consulting. And then I don't know, 2003 or so, I said, okay, I'm done traveling 5 days a week. That was the time when the consultant still had to be at the customer side 5 days a week, and basically I need a pause. And I just said, okay, I like writing, so I talked to a professor of mine. Said, look, I need a pause. I want to do something that I really like and write about systematic or software-based trading systems. And he said, great, let's do that. And actually after that, I wanted to go into finance. But friends of mine tracked me back into IT consulting and IT management. So I actually did that until 2020. The last, well, whatever, from 2009 to 2020, I was as a CEO of a company that grew from 18 million to 50 million. It's now 70 million. But 2020, I just said, all right, you have to do the switch. If not now, you're now 50 years old. You have to do the switch. And so I said, all right, Gonna take all my money, live off that investments, and yeah, then I found out that's pretty lonely, right? So I started writing and meeting people. I met Curtis and other Ryan and other on X and other platforms, and yeah, it's just I mean, my trader network, they're doing everything: options, small caps, day trading futures, and I just love it. Love the community. And then I don't know, Curtis, when did you say to me I should work I should work for Portfolio 123 last summer or so?
Yeah, about that. I mean, I've always wanted it, but I think that's when officially, yeah,
Yeah.
out to you. Yeah.
Yeah, and then I said, hey, great. I was a customer, a little bit more than a customer since 2011. More a fellow, wrote about Portfolio 123 and everything. And I said, yeah, great. And then we sat together with Marco. He runs Portfolio 123. And yeah, since October, I'm on the team. Best engineering team I ever worked with. And I worked almost 30 years in IT. Great company. Really love it. Nice, really, really nice people. Really quality driven and customer driven, customer focused. And yeah, that's what I'm doing now. So basically, it's one part I write my blogs and do network, and the other part is consulting with Portfolio 123 and do all the calls from Monday to Friday. Basically, if you want to have a demo, you can go to the website and meet me. And the third thing is basically managing my own small cap portfolio. That's what I'm doing.
Awesome, man. That's a great bank. And yeah, must have been. So, Andre, did you actually sell your company that you were the CEO of? Did you sell it? And
No, I wasn't owning it. I was
Okay.
hired basically. I was a hired gun.
Okay.
And probably, I mean, financially, it was probably not the right decision, but I said, all right, it's the last day of my life where I wanted to or do something I don't like too much anymore. So since then, I just do things that I like.
Nice. Okay. Well, that's awesome. That's important, man. It's cool.
Yeah.
So, all right. Thanks, Andreas. Hi, Curtis. What about you? And maybe even get into how you guys met over time too.
Okay. So my journey is gonna start when I was just a fetus. No, we'll fast forward to when I was 5 years old, actually. I loved investing because my dad always promised that if his gold stocks, he's just only into exploration gold stocks. He says if they take off, we're all going to Disneyland. So with that as the prize, I'm looking through, the bid-ask spreads in the Vancouver Sun, the paper, and sure enough, actually he had some gold stocks, Pioneer Metals, that did amazing. Like from penny stocks, I think at its height it got to about just under $19 a share.
Wow.
And then Black Monday hit and it just cratered. And I remember I'm 11 years old trying to reason with my dad, being like, it's still above where you said we could go to Disneyland, and trying to reason. And it was like a half an hour discussion. In the end, he's like, it'll bounce back. And unfortunately, it didn't. So that was Disneyland. I always followed it. My brother was into day trading back in the dot-com era. I've always just loved investing, but unfortunately, I went to school for forestry science. And over time, I moved to an area of Canada where there's basically no trees on the East Coast, no harvestable trees. So I wanted to take my passion and do something with it. So that's when I started writing about investing. I eventually found Portfolio 123, where I could take all these ideas and actually test them with high quality data. And from there, I actually did a little bit of support work with P123. And that led to, there was a billionaire that phoned in and he asked for some help. And I said, I'll find you some help. I'm not the guy. Like, I love investing. I'm like digging into strategies. And he said, no, I want to meet you. So he flew my wife and I out to Santa Monica. We met at Cap IQ headquarters. He hooked me up as part of a two-man team with the head trainer at Cap IQ with the software they had. And so from there, that was around like 2012. I've just been working with funds, family offices, and I got the hands-on training that I needed to couple with my passion. So that kind of takes me up to today. Oh, and then Andreas, his models were outstanding, particularly in small cap, micro cap. Like he would design models and let other people lease them. And I kept seeing his name at the top of the leaderboards. Like these models with just like 50% yearly returns, and they're good sized models too that can handle decent amount of fun. So eventually I just reached out to him. I said, look, there's an opening at P123. They need some support. You'll be able to meet a lot of interesting people, and it's what he needed. And so, yeah, now I get to work with a great guy.
Beautiful,
Nice.
beautiful. And I saw, I guess, and I saw some of the returns. You did some back testing, Curtis, on what you were doing too, and it was pretty impressive. Not just the returns, but how the stocks would do like when the market was going down,
Right.
even using today's current kind of environment. So I think that's what I find like. And by the way, you guys, so you're on LinkedIn, Curtis,
Yes.
and you're seeking alpha.
Mhm.
Do you, Andreas, do you write at all, seeking alpha at all, or anything like that at all, or?
No, I got my own blog. We can put it under the video basically. It's trading for a sub 1 million account. It's the Substack,
Okay.
and I'm on Twitter too. Yeah.
All right. Great. Awesome. So yeah, we can just actually get rid of this down here.
I'll just
Stop
interject
sharing.
one thing, Maj.
Sure.
Whatever you've seen that I've done, and this is being completely honest, it's not just me trying to be humble. Andreas's stuff is about 2 to 3 times better. Like, I'm learning a lot.
No.
I'm learning a lot
My
from
best
him.
out of sample model has like 35%. Yeah.
Well, just wait till
Since
you see
2020
his
or
stuff
something
and
like
what he's
that.
doing in AI later, Maj. It's
Beautiful. Well, that will help. Well, I think regardless, the two of you together can help definitely elevate what we're doing. So that's the good news.
okay. Fantastic.
So I'll tell you my what I've been doing and how I think you guys can help to some degree. One of the things is what I always try and do when I'm doing running a business or investing is what do I do best and what I not do so good. And I know I can pick stocks and find stocks, and there's an approach you can use. It's easy to find quality stocks, and over time, I've been doing this for now over 30 years, close to 40 years maybe, and you start to understand these things that keep recurring to make stocks do well. Not just on the numbers, mainly I really focus a lot of my career on understanding business models and the qualitative nature of investing. When it came to quantitative, yeah, sure. I dug into the basics, valuation and ratio analysis and all these things I would like to see in a company. What I never really did though is really and my sell strategy was basically very limited to a certain quant things here. I guess you could call it that. But I never really took it to a level of just looking at all these particular quant factors and how could it help me and also take out the behavioral kind of bias in what I'm doing. That's really tough. And the toughest part for me is saying, okay, well, it's always the FOMO, of course, right? And a fear of selling because your stock's going to go higher, right? And we don't think about the other way. Well, I'm going to sell, it's going to go lower. We always think we're going to sell, it's going to go higher. And quite frankly, you have it. Look, you have a chance of that you sell stock. They can say the same. It can go down. It can go up. And there's three, and sometimes they're going to go up. But then so in the very early in my career, guys, I was more of a shorter term investor in terms of my holding. Everything was based on fundamentals. But it was still like a 3-month to 12-month hold. And I would only try and buy stocks right before I thought an inflection point in growth was coming.
Smart.
Provided they were undervalued, and then selling a quarter before that ended. That was my kind of thing. How can I get in a quarter before, and how can I get out a quarter before it starts, and how can I get out a quarter before it ends? And I was only really focused on earnings per share. That was basically can I get this really kind of cool earnings per share momentum and then get out. And it worked well. And I'm not going to sit here and have all of the results with everybody here. So you've been cautioned, but I was using margin too, by the way. So I don't know what the risk adjusted return was, but I was more than double my money every year for a good 20 years. But I had what I wasn't doing right when I had those drawdowns. and the drawdowns in the currency crisis in the 90s, I think it was the 96 maybe. Then I had of course the dot-com area, then of course the internet crash, and now you have today going on, right? If you have all these things, you had then the 2022 inflation reset. So, you know, greed is good because greed makes you make a lot of money when things are going well, and the market's usually doing well. But greed can punish you very quickly when the market's doing bad, and you have these huge resets. So even though you have these great 10, 15 years of performance, a lot of it can be taken away if you're not prepared in these other times. And what I realized was when I was doing this shorter term investing based on fundamentals, I'm recycling them. I'm always reinvesting. So you just end up being in this hamster wheel sometimes. But also what I realized there were stocks I shouldn't have held. There should have been stocks I shouldn't have been holding. And those are the ones that get you in trouble, especially if you're going on margin. And so I figured, you know, what would kind of be cool to have could quant investing potentially preserve some of those elements of what I'm doing, but also kind of help me manage risk better. And it's really relevant too for our subscribers at Geo Investing and our subscribers at the Cliff Notes, because we know we're not investment advisors. We're not going to sit here and telling everyone what to buy, when to sell. We do bring stocks to our platform through model portfolios. In Geo Investing, for example, we have model portfolios. It's our best effort to let people know, hey, what we think the best stocks in our coverage universe are. We cover about 2,000 stocks. You know, which ones have the biggest upside. We like to say, okay, when we put a stock on some of our portfolios, 50% short-term upside, what we might be expecting in long-term multi-bagger status. But how do you manage that across that is tough. You know, and same thing with the index. We have 110 stocks there. We think they're all, we put them on there because we think they're going to multi-bag. But how do you manage volatility across that? And you, of course, you can use valuation to some degree, but there are probably other things you can do too to help manage that too. There's momentum. You know, I was a big momentum investor myself. My first 20 years was all momentum. Momentum comes in, then I look at valuation. That's what it was. Stocks new high list. Okay, are they undervalued? Buy them, right? And I used to try to buy them ahead of the Investor Business Daily, of the IBD. And so that's where we're at here. And I want to know if I think maybe less important for me, but more important for our subscribers. Could we partner with you to help them make better decisions through maybe a systematic approach? And that is a combination of ranking these stocks already in our coverage universe. We'll start with that. And then maybe having some type of rebalancing portfolio going on with what we're doing. If that goes well, maybe we extend it to a bigger universe of stocks. There's 10,000 Microcap stocks. We're tracking about 2,000 we think are at least enough of a quality to monitor. But maybe you can help us better manage the whole 10,000 universe, if maybe bring some stocks into our universe that we're not even looking at yet. There's always so much you can do. We do a lot of manual effort. Even now with AI, I'm sure you guys can help us with that too. And so that's a mouthful, but I wanted to set a table with all that and maybe get your thoughts on some of that stuff here. And I think, you know, behavioral analysis, that's one thing we all suffer with. I'm assuming quant investing really takes a lot of that out of investing.
Not always. Still hard.
In theory, right? In theory. Yeah, so that's it. I'll just spitball on there. So what do you think about that? And what do you think what you guys can what could you do to help us kind of further some of these goals?
I think we can learn from each other. I mean, I really have to say that the best ideas I got actually from discretionary traders like you, right? So this is kind of a triangle, right? So it's academic papers, it's people like you that are successful and picking their brains. And then the third one is backtested yourself, right? So that's kind of the triangle. And I just heard two very important things in small cap investing, and that's basically value doesn't help you if earnings don't go up, right? So the inflection point, getting the inflection point right, I think is really, really important. And I think that a discretionary trader can do that even better than a system. Because if you do basically the due diligence and you know the company, but where Quant can help you is basically limiting the universe, right? So right now you have to put it down to 2,000. Maybe we're able to help you to get to 100, and so it streamlines your process. And also, obviously, we have momentum in the models, and we also have earnings momentum in the models. But we would be, you know, my best models, they actually get those breakouts, right? But they're in the second day. They're not in before, and you would be in there before, right? If you anticipate in the right way. So I think limiting the amount of stocks you look at is a great thing. And also the next step might be, okay, I might say, all right, part of the capital I still trade discretionary with the help of Quant with shortened watch lists. And maybe some part of the model, some part of my money, I just go 100% systematic, right? With basically your ideas putting into ranking systems, value momentum, earnings acceleration, and that part I just trade automatically. And again, you know, I saw your basically your factors. We backtested them. They're very, very strong. And actually, what was really interesting is that when I compared your ranking system and the portfolio strategy we built with it, they pick really different stocks than my traditional or even AI system. So that was a really, really nice experience. And yeah, I think if we, you know, put our brains together and basically, you know, work on it, I think we can profit and learn from each other in a great way.
Awesome, awesome. And look, and there is something to be said, by the way, about what you're doing in terms of if I'm trying to find these stocks maybe before an inflection point occurs, there's a risk in that too, though, because that could be wrong. You know, so getting some confirmation of
yes.
earnings momentum might be better. I don't know. Yeah, it's going to be interesting to see, like for stocks that we're picking on our side before they, you know, maybe before they get to where you would pick them, if other factors you're looking at least supports a bullish view. You know, we can start figuring out like what that looks like. Like of the stocks we're picking that you wouldn't pick, how do we narrow that down to, okay, the ones we shouldn't be looking at, to the ones, all right, maybe these got a chance because other factors you're looking at are good, right? And there's so many things to look at, right? I mean, there could be a situation where changes in the balance sheet, changes in margins, are basically potentially telegraphing something to come ahead. Like one of my favorite ones to do, I don't know if this is part of what you guys do at all. I like looking at stocks that don't screen well sometimes.
Yes.
So, for example, you might have, like KEQU is a good example. KEQ is a stock I own, all disclosure. Not enough of, but stock's pulled back hard recently. But that stock back in 2 years ago was selling about $10. And these guys make scientific laboratory equipment and furniture. And it's a solid company, really solid company. But old management just didn't manage it well. And they were suffering with lots of losses. And so a new CEO came in, and his plan was to basically restructure the business in a way to make the margin stronger, which was going to cause revenue not to grow for a little bit of time. So you had this period of probably 8 quarters of just going from losses to profitability, big profitability without any revenue growth. And the stock had that first multi-bagger move. It went from, you know, on that. And now what we have going on now is a second phase in the multi-bagger, hopefully, where now you're going to have revenue go up and they can make acquisitions. So stuff like that. Do you look for stuff like that? Ways to, you know, models that basically kind of pick up on things before investors see the obvious? I'm curious if that's part of what you do.
Yes, I mean, again, 2 things. Earnings inflections are really important. The second thing is sometimes you don't get the earnings, right? At least we don't have analysts so we don't have the data. But then it's momentum, right? Momentum is, especially on small caps, is a proxy for growth. It took me years to understand it. I mean, I got so many breakout traders that make much more money than I am, much more successful, and they just look, they just look at the chart, they just look at momentum and patterns. And I always wondered, why is that? And then I found basically papers that said, all right, momentum is a very, very good proxy for growth. That's the first point. Second point is, actually, I think the best companies are really shitty companies that turn around.
Right.
You see it on the mid caps or big caps. You saw it on Carvana, basically, right? Everybody said they're going bust, and it was really bombed out. And then, a low quality stock based on the screen turns around. Those are actually the best stocks, and it just built an AI factor system that targets low quality stocks. So I don't know, what do we have? Altman or something like that. That's kind of a quality measure that we have in the database. And I filter the low quality stocks, and the strategy just got much better. So only if you combine it with earnings growth, but obviously low quality and earnings going down, that's not a good combination. But yeah, we just built something like that, and I just allocated money to it actually last week.
Excellent. One second, I just got a message here that this is not being recorded. Zoo, are you there?
No, it gets recorded.
Is it? Oh,
Yeah,
okay,
it says
I'm sorry.
Yeah.
That would not have been good. Okay. Yeah, I think so if you look at our MSQI, so we have the index of a Substack that's called MS Microcap Quality Index, and the M stands for momentum, and the S stands for sustainability of business. MS Microcap is for quality, and I is for index. But we are looking for these quality companies that are going through inflection points. We're also looking though for high probability turnarounds. So that's kind of what you're talking about, these low quality companies. That's where you get the best stuff, right? You're right.
Yes.
And that's my favorite to kind of dig into. Gets you in trouble sometimes too. But cool, man. So in terms of when you're looking at, I will come back to some of your factors, and I want to come back and talk about them in a second. But when you look at the way you, and Curtis too, I mean, I don't want to, you can jump in anytime, Craig. I don't want to mean not to talk to you there. How do you guys look at your weightings? Are you doing, do you kind of manage as a really equally weighted type of strategy? Or are you guys putting weightings on these things based on your factors and rankings?
Are you talking about weightings of positions or weighting of the factors themselves?
The position. So let's say you picked 100 stocks you want to invest in based on, or 15 that you wanted to invest in based on what you did and your factors. Are you doing it equally weighted on those, or are you actually positioning different weights to the portfolio?
For me, I've always equally weighted. Every time I've tried to monkey around with it, it goes sideways. So I don't know. Andreas can speak for what he does.
Yeah, I mean, sometimes the strategy gets better if you tweak the weightings, but the volatility also, total return goes up, but the volatility too. Oh,
okay.
Yeah.
So you try and stay more of an equally weighted index. It's
yes.
less thinking too, right?
I got some, so to say, kicker strategies that don't find a lot of stocks. They might, the strategy might be designed for finding 30 stocks, and sometimes it only finds 5. And then I say, okay, the minimum weight is sort of, if it is 25%, so if it still finds 4 stocks, it will be still 100% allocated. But they are really, they have great results, but they're really, really volatile. So it can be only maybe 5%, 10% in a strategy book. You can take those. I call them kicker strategies.
Okay.
You can put them into a book, but don't weight the strategy too high in the strategy book, because otherwise you're
Right.
I mean, you can do that with 10K or 100K, but if your portfolio grows, then psychologically it's really hard to trade them. Yeah.
Right.
And
Okay,
the reason,
sorry. Yeah, Curtis, sorry.
just the reason that I find equal weights good is because it's so hard to know specifically which stock. We don't zoom in and look at what the actual triggers might be. That's more what you do. And so like for my approach is more, first I try to lower as much risk as possible. You know, these aren't stocks that people hate. I mean, there's the turnaround ones, of course, but I just try to lower as much risk as possible and then put a few possible drivers for growth. Like, is there going to be some growth? Is there, you know, do they have access to funding? But you don't know which one's going to take off. They'll surprise you sometimes.
Yeah.
So it's a bit of a gamble rolling the dice, I find, if I wait too much in any one area.
Right. Yeah. I think, you know, I have this, sometimes just let the portfolio kind of weight the portfolio, you know, the strength of the stocks can sometimes determine my weightings. Yeah, so if a stock is doing really well, it ends up sometimes being the bigger weight because it deserves to be the bigger weight. But I guess on that same subject, are you guys rebalancing to equal weights too as stocks go up and get to a certain percentage of the portfolio? Are you paring back some of it to get to equal weightings all the time? Like I mean, how does that work for you guys?
Yes and no. I got strategies that basically you know, rebalance to equal weight. Or you could say, right, if let's say if the idle weight would be 10% and it goes up 40%, the strategy doesn't let it go more up than whatever 40%. So the max weight would be 14%, something like that in the strategy.
Okay.
So that backtests pretty well on small caps because they have fast you know, bursts. And then they pause, and then volatility starts to kick in if they whatever up 50 or 100%. And other strategies, I just let them run. It's also a question of how many stocks do you basically have. You got 50 stocks, doesn't matter. Let them run, let them do their thing. Yeah.
Beautiful. Okay, that's good now. Now regarding momentum, because that used to be a big part of my strategy. And it was only because I had to pick something. I had to pick one way to reduce the universe of stocks. So I just used momentum. I remember when I first tried to figure this out when I was just starting investing, like how do I want to reduce that universe? And at that time, like, and we're talking, you know, 1988, 89, whatever, so a long time ago, there wasn't really much available. So I had to, and I decided it was either going to be new highs or new lows. My instinct was new lows. I'm gonna buy all these stocks at new lows to get all the values right. And that didn't work so hot. And then I went to new highs. And what I really learned was I kind of like took 200 new highs and 200 new lows and I charted them out, and there wasn't really any weird edge there. So I figured, okay, that's why I decided to go momentum plus value. I added a value to the thing. And I remember reading a study back then was that looking at these stocks and new lows, maybe they have over a longer term performance, maybe 5-10 years from now, might do better than momentum. I don't know if that you've noticed that at all, versus picking momentum stocks. Like is there a strategy you have in place for finding these stocks that are falling and hitting new lows? Is momentum very, very important to part of both your strategies? Have you kind of looked at that at all?
So I'll just speak first. I'm honestly not a big momentum investor. My brother was huge into that when he was doing the .com stuff. I use it a little bit, but it's not a key part of any of my strategies. I really go by the fundamental ranking of the system. And generally speaking, if all things being equal and it has fundamental strength, earnings growth, and the prices are dropping hard, then that's going to even rank even higher on.
Okay.
So it's going to be something that I'm going to generally pick up just because the valuation and free cash flow yield, everything's going to be that much better.
Cool.
Yeah, I use it a little. I'll use it a little bit, especially on small caps where I don't have earnings estimates. But it's never momentum alone. That's actually not on standalone. It's not good. Value and momentum combined gives some interesting results, though not so highly weighted. And also, I use industry momentum. I think it's even more important than momentum on the single stock. Yeah.
Beautiful. Well, I think that'll be really good for you because it's great working with both of you because on Curtis's side is we have a buy and pullback model portfolio at Geo Investing.
Yeah.
Which tries to buy stocks that are falling that shouldn't be falling. So that's great with Curtis. You kind of and I love that you have momentum on your side, Andreas, because that's a lot of what we do. So it really, I think the three of us together really can find some special things.
Yeah.
because we're all on that.
One thing is, I think what works better really on small caps is fundamental momentum. So basically sales increase, earnings increase.
Yeah.
As we spoke from turnaround stories. Yeah, those are the strongest, I would say.
So when you are looking at some of your strategies here, I mean, Curtis and others, really, are you looking, how many factors are you putting in your, give me an idea. Is it like 50, 100, or is it 3 or 4? I mean, you have different, you have some that are very little, some that are a lot. Give me an idea. Because when we break it down, it is about earnings and value, right? So what if it, yeah, I mean, maybe give me that kind of perspective there.
Well, one of my best ranking systems has 150 factors.
Really?
So
wow.
Yeah, and the reason for it is, I mean, there are different what I call meta factors, right? Something like momentum is a meta factor. Something like value is a meta factor. Growth is a meta factor. But you need more, usually more than one portfolio 1, 2, 3 factor to catch momentum, right? So momentum, you have to decide whether it's 3 months, 6 months, 12 months. So why not put everything in the ranking system and rank those 3 momentum portfolio 1, 2, 3 momentum factors equal weight? So sometimes that's 3 months momentum is hot, sometimes 6 months is hot. So you diversify a little bit in order to catch that meta factor, basically.
Right.
So that's the first thing. On the small caps, it's not all the data is there, right? There is a lot of NA. They don't have to report in that, don't report all the data. So if you're unlucky and only have 10, 15 factors, and they, in one certain time they don't have a lot of data, then you just lost the base of your system. So I like to combine a lot of factors, and we also see in the AI factor system. So the sweet spot is really, they call it features. I don't know why they call factors features. So the AI community, and so the sweet spot is really something about 100, 150 features. You give that to machine learning, and the machine learning then figures out the ranking system, the weightings of the ranking system. So that seems to be the sweet spot. And another thing is, in the direction of design principles. People come to me and say, "Well, you have 150 factors in there. That's too complex." No, it's not complex. Mm-hmm. That's actually really, the ranking system itself is super robust because the expression is linear, so it ranks from 1 to 99, but it is able to capture non-linearity. So it tries to capture the right tail of the distribution and avoids the left tail. And it's doing that really, really well. So whenever I see a great system, the first thing I look is, I look at the ranking system and I check the buy and sell rules of the strategy, because there I'm a little bit more careful, right? So the buy and sell rules, if it's rank based, that's fine. Otherwise, I live by the rule 3 to 5 buy and sell rules, because there you make your assumptions, right? And maybe you make an assumption that quality small caps are great, but maybe that's wrong, right?
Right.
Ranking systems are super robust. If you have point in time data like portfolio 1, 2, 3 has, no look ahead bias, no survivorship bias, then that's the way to go. I mean, we also have we have a Buffett system. It's out of sales since 2013. It has 5 factors, and it's doing great on the Russell 3000. So I would say there's a hard rule, but the stuff I'm trading that has a lot of factors, yeah. And Curtis, you got some 1 factor systems even that work very well, right?
Really?
I've kind of went to both ends of the spectrum.
Yeah,
I've designed stuff with 2, 3, 4 factors in the microcap, and they do work well.
Mm-hmm.
I've designed stuff with 150 factors. But like you, I think the idea of having 4 or 5 main styles or meta factors and weighting amongst those is important. And I do think that I should have more factors. For instance, if value is working, but maybe it'll shift between price to sales to price to free cash flow or something else. Well, then you get caught if you're only focusing on one. So even though I have my favorite factors, it is good to have a blend within each style category. But yeah, I mean, you can make 3, 4 factor portfolios, will they be as robust as the bigger ones? No, they won't. So.
Interesting. I'm wondering if are the additional factors, like for me, it would be just momentum and, you know, earnings growth, sales, a little bit of sales growth, you know, kind of criteria, and maybe a few risk, you know, ratios from the balance sheet and stuff, margins, the income statement. Do these other factors kind of, you know, we all do know that earnings really drive prices over long term. Your earnings is what drives the ultimate, you know, the multi-year 30-40 bagger, right?
Yeah.
But are these other factors kind of a way of checking to make sure that that's going to happen? Is that how you would view them, or is that the wrong way of viewing it? Because earnings is one thing, but you also want to figure out, I guess, can that earnings momentum continue?
Well, I think
are these other factors helping you do that?
Well, I think too, there's also, like, say you have earnings, sales, operating cash flow, free cash flow. So you've got a few different variables, but then you want to analyze different aspects, like trailing growth over different periods. You want to look at acceleration of growth. Like, is the short-term growth picking up or is it declining? Because that's important. So once you start doing that amongst 4 categories, you can very quickly have 40 plus variables just with growth.
Okay. Excellent. And are you so I want to now start getting into a little bit of the factors and stuff, and that you may or may not do. So as you know, I'm very kind of big on quality. So you're using some of the factors you're using, I guess, on the quantitative side are still measuring quality, right? Is that how you're looking at things? Okay.
Absolutely. Yeah.
That's what I thought.
Absolutely.
Okay. So and with something like backlog, would that be in there anywhere? Are you taking into account backlog in any of your factors at all?
Of course, do we have backlog as a factor?
Yeah, does portfolio 1, 2, 3 have backlog kind of data?
I don't think so.
So what do you mean by that? Like that there's sales on the books, but the cash?
Like contracts. I'm wondering, like, what I'm curious is, like, some of the stuff I pick up, if what we could do, maybe, I don't know how we would do it, but there might be some interesting stuff I'm pulling out in my research, like backlog. Can we start implementing some of that in the system?
So like accounts receivable, accounts payable, if you mean that, yeah, they have that. And then you compare the actual cash flows to what supposedly, you know.
Well, I'll give you an example. So you take a stock called a frequency electronics. The stock symbol is FEIM. And you can see the performance of the stock over the last couple of years. It just really, the momentum started maybe the last 18 months. And the key to understand that multi-bagger move coming was basically 2 things. That the backlog was growing to all-time highs ahead of the growth in earnings. But more importantly, the margins in the backlog with new management was about to go from 30% to 50%.
Nice.
So that's we got that information from reading an earnings call transcript. It wasn't in any press release. So what I like to kind of try and do is, how do we really create, well, we call it information arbitrage here at Geo, is find this information before the street that's not really picked up in any of the screens yet or by Main Street. So could we incorporate, so the backlog was increasing. And you could go in that backlog and I could calculate what I thought earnings per share were going to be soon based on the disclosure. You just take that backlog. We know the backlog was going to be filled within 12 months to 18 months. And we know that we're moving to a 50% margin kind of assumption. Once the old backlog is kind of cycles out of it, we're probably going to be in that 40 to 50% gross margin area. I would like to understand how we can maybe start, and that's how I think we could find some stuff before your model maybe.
Yeah.
Could we start making our own scoring system on that stuff at all? And does it make sense to do that? Kind of cool. So if I find, for example, information in a conference call transcript that's not in the press release, that's bullish, could we assign a number to that? Like, okay, that's just, hey, that happened. All right.
Yes.
Cool.
So
and we could
basically,
probably and I can have my analysts have been doing their own analyst estimates and give them to you guys to kind of pop into your, even though it might not be in portfolio 1, 2, 3, we can still kind of make adjustments to it, I'm assuming.
Yeah, basically you can define your own factors and import them to the
Oh, nice.
to the database. Make sure they're point in time so you really get the data right. Otherwise
Right.
the backtest won't be realistic. But and I think that's really the smart. And I'm a systematic trader, but um I really like guys like you geo-investing in general, because that's really how you beat the market, right? Let's just say that FIM, we see in our data, it's going to survive the next 12 months, right? It's doing okay. It has great value, maybe has this and that quality factor loadings, and so maybe it's ranked in our small cap universe at 80 or 70 or something like that, right? Rank 70. And then you take your information and add it to the stock, and um, it would be ranked with 95 or something like that. So you basically can buy it.
Right.
Obviously, you make that in your process as well, right? You would not buy FIM if they would only have 6 weeks of cash, no matter the backlog, right?
Sure.
Without
Yeah.
that's 6 weeks of cash without refinancing probability, right?
Right.
But we could bring that to the table, making that sure, make the list, the watch list smaller, and then you could dig into that arbitrage, information arbitrage you're basically doing. Yeah, put points on it. We import the factors, and then maybe it's not. Maybe you might not have that data in the past, but we could still import it, and you could at least have a snapshot of the best stocks right now, and then basically make the portfolio construction. Yeah. Oh, it's
And
actually really, really smart what you're doing. I really like it. Yeah.
Awesome. Awesome, man. Go ahead, Curtis, you're saying?
yeah, I just wonder if the approach might be like Andreas says, to first come out with the quant stuff and then maybe add
Yeah.
the qualitative later. Because if you're going to add a data point like backlog, you have to add it to all stocks in the universe.
Yeah.
If you can't just add it to one or two stocks. So that's going to be a lot of work on your end. Whereas if you just export and here's all the top quant stocks, and then on like an Excel sheet, then you can just manually put in, and you can customize the rank there too. Like just assign a weight for whatever the backlog is. And, for 30 stocks, it's not a big deal to do
The
that.
problem with the backlog, like a lot, I wouldn't say, well, I don't think a lot of, it's a small percentage of probably, there are those that I guess we could do a screen for a quant strategy for those that have backlog maybe, but a lot of stocks aren't going to have backlog.
Yeah.
Yeah.
That's gonna be part of an issue too, I guess. But one thing too, Curtis, staying on the FEIM, I'm curious how this would have played out with you. Is that like FEIM had a situation? You'll see a lot of these stocks, especially in the industrial stocks that have project revenue, is they'll have maybe a bad quarter because there was a delay in the order, and it's going to hit next quarter. But there might not be any financial estimates. So you might have had, let's say you had 2 or 3 great quarters in a row. It's ranking high in your system because that's all humming. Come in with that fourth quarter that comes in well below year-over-year growth. But it pulls back hard. No estimates. Like in FEM, that happened in FEIM. I was buying into that dip when that happened because on the conference call we learned there was a delay and it was going to be made up. And then the company came out with a press release 3 days later saying, no, we're reiterating that this is a one-time thing. So how do you you think there's a risk, Curtis, like that some stocks will come out of be ranked low because of that 1 quarter miss without the context of what's going on the qualitative piece of the things? I'm wondering if you see that as a potential problem.
Ah, man, I would have to dig into the actual stock itself to tell you there, Maj.
Right. Okay, that's fine.
I just did.
It'd be a good case study. We would go back test that one.
Yeah,
FEIM.
exactly.
Yeah.
I just did. I just look at the screen right now. Can I share my screen? Is that possible?
Yeah. Let me make sure. Is it?
Okay.
I think you should be able to do it. Go ahead. Yep.
So what I'm having here is that's the price, right? That's the stock, right? Frequency of electronics.
Yep.
I'm on the right stock. Okay.
Yep.
So that's the price, right? So you basically probably did your due diligence here, right?
Right.
And it actually ranked pretty high. So on a small, that's something that comes out of the
Nice.
box. So we have like 60, 65 ranking system, and that's kind of the go-to ranking system for small caps. It's done by a very, very smart quant. I'm using parts of it, and so basically what it's saying, right? It's everything in there: momentum, industry momentum, earnings acceleration, ton of factors. But that's actually what I really love. If I would look at that discretionary, I do a little bit of, because I have a gambling addiction, do a little bit of breakout trading too. Not that I'm successful with it, but when I look at that, that's just beautiful, right? Nice base, and it still holds a pretty high rank, right? So since here's momentum in here, that drags down the that drags down the rank, right? So momentum is in a ranking system, and there is no momentum here, right? And it still ranks very high. That's really a good sign. So my system would probably, one of my systems would probably buy it somewhere here, right? So now it shoots up, right? It shoots up to 90. Well, actually, it would have bought it here because I filter to my buy filters rank over 95 and 97. So probably would have bought it here, something like that. And now we basically see that this price drop here, right, might be a good buying opportunity because it still ranks very high.
Right.
So yeah. So
it's
your
interesting
analysis, right?
ranking high
If you
all
see
the time.
something like that, if you see something like that on the rank, and you see, all right, margins increase and backlog and whatnot, right, and then you see a base, that's strong. That's really that's nice. Yeah.
Well, you mentioned one too that caught my attention here is that if you have earnings momentum going on, right, but no price momentum yet, that might be really back the truck up, right?
Yeah.
Potentially before maybe the move happens, the momentum. Yeah,
exactly.
This is pretty cool.
If I could just share my screen, because I just want to share the ranking system where I kind of combine some of our thoughts, Maj, some of yours and some of mine. And I'll hide all the factors. No one will get the secret sauce here. But I just want to show you how that would have played out. Okay, where are we here? Screen 2. All right, are you guys seeing that?
Yep.
Yes.
Okay. So right where the ranks jump up, like into the
wow, nice,
mid-90s,
super nice.
That would be right around like the $17 mark after it kind of bottomed out, shot up, and it's been very high ever since. It's dipping down to like 92. So this is roughly right where the gray starts, where you would have caught the stock.
Nice. When it's flat, yeah.
So that's the power of qualitative and quantitative, in my opinion, and it's only going to get better from here. So
beautiful. So you guys, so step one really. Before I even get there, I want to talk about also my zombie index. I don't know if have we talked about that at all, Curtis?
I forget a lot of things.
Yeah,
so
I don't think we did. I don't think we did. A lot of emails.
I read it shortly, but yeah.
So basically, since I had part of my career with Geo, at least between 2000, probably 10 and 14, dealt with shorting stocks. I had not shorted my whole career until I started investing in U.S. listed Chinese companies. And then they ended up being a lot of fraudulent companies and relying on their financial statements. So we ended up going short. There was a documentary that was done. We were a big part of it called The China Hustle. My partner at the time, Dan David, was the orator of that. And financed by Mark Cuban, and talks about that. But then during that time also, I started getting the shorting pump and dumps too, like U.S. companies, like low quality pump and dumps. Partly because early in my career, I got, like a lot of young investors would do, I got sucked into a lot of them, lost a lot of money in them. I never touched them again. And when I started shorting China, I revisited the pump and dump theme for short. So I did it for a while. It was great. But I got my head got a little. I didn't want to be a short seller because your head just gets totally out of sync, and it becomes harder for me, and especially with not being a quant investor. Emotional behavioral now, behavior bias comes in, and it's really hard. It was hard for me to do both. So I went away from it, and we went back to really transitioning geo to only long, because there was a point where geo was doing both. And then, thankfully so, we went into this really low interest rate environment. Low quality was just doing really good anyway. It was really hard to short just on low quality. The reason we were successful with geo, we were basically shorting frauds. They eventually just would go to zero. The SEC would get involved. Then the SEC after 14 started getting a little less involved and letting the market take care of it. So when you had the GameStop stuff happening in 20, imagine this, you basically shut the lid off fraud, and you can do low quality was going up like crazy. You could refinance your debt at real low rates. You could raise money in the market at will. So you basically fund your losses for a long time. So 2022 kind of changed that. Rates are now reset, and quality matters again to some degree, at least moving to quality. So these zombie, I call them zombie companies, are these companies that just have to raise money out of cash, losing a ton of freaking money, just like crappy companies. Most of them are in that small microcap kind of arena. And when we launched this, so before I launched the Substack index in February of, late January of 24, I had been kind of back testing the index since 2022 to see if while I was back testing the MSQI, I was also back testing the zombie index, which was basically these companies I thought we should short. They're all going to go to zero eventually, or just keep reverse splitting and coming back down. So during the time the MSQI was doing great, that from 22, of course, it took a dip here in this first quarter here. Also, what's going on at the same time was that the zombies were also making positive return. Oh, they were down, but negative would be positive for a short selling index. So the whole thing was go long the MSQI and go short the zombie index. And so we were getting probably, and the MSQI, by the way, is a equally weighted, no rebalancing thing, and it probably ended up at the top of the market when you do it all back, was CAGRing close to 30% a year over that 3-year period.
Nice.
With no rebalancing. At the same time, you're getting the zombie index probably making, 15, 20% during the bull market, so you're getting this wonderful alpha on both sides. So it's, it was great to see in a bull market, especially during last year, where you had making money in your longs and making money in your shorts. And so I was really curious to see now but what I thought most interesting about the zombie index was that it predicted this crash here we had here. So at some point, the zombie index retraced all of its losses, and those stocks are going up, right? So you had at the very peak of that moment, you saw the euphoria got too high, and the market, and it was actually the market was falling even before the tariff thing happened.
Yeah.
So I really want to explore how we can maybe take a look at the zombie index as a way for us to measure sentiment, and maybe give my subscribers and even myself a way to manage the portfolio with maybe hedging techniques or whatever. And we have good. We're in 2-3 years of data, or 23 and 24. No, actually, is it 3 years now of data? 22, 23, and 24 on that, and now we're going into our fifth year, our next one with 25. So I'd be kind of curious to see and that's a very, we're predicting basically either bankruptcy or predicting just the continued need to raise money kind of thing. And these stocks, they go up, they crash, they do a reverse split, they crash again, reverse split again.
Yeah.
So you can keep going back to the well on that. And if anything, if for the one thing, it might be, hey, when we see that index get to a certain level, we should start putting on some maybe hedging techniques on the main portfolio, especially if you're up a lot.
Yeah.
So if you're up, like a lot of us were in 2024, it would have been great to protect profits if we had some kind of way to do that, right?
Yeah.
And now again was an equally weighted, very small position kind of assumption across a lot of stocks. And we have Jan, my analyst, has all the data on terms of the ability to borrow, the interest on the borrow. So we have a lot of good data on what stocks you couldn't have shorted, so we don't. There's some bias in this because we assume you can short every stock. You can't short every stock probably in the index, and at the level you need to. So I like. Is that something you guys can work on with us too on the zombie? Would that be at some point? Have you done anything in the short side at all?
Yes. I implemented a strategy on small caps, shorting small caps, microcaps.
Nice.
I published it even, so it's but I on the title I basically put in, not realistic, because I don't know, do I get the lending, right? So basically the same,
Right.
what you just discussed. So do I get the lending, and what's the lending fee, right? I don't know that either. So,
Sure.
but still, it's doing very well. And in my network are basically traders that do nothing else. They say the same thing. You need to specialize, right? So you either are very good at being short or very good at
Right.
being long. And so otherwise it really is difficult mentally, right? So whenever I'm successful shorting, I have problems when the bull market comes back, right? I'm usually late if I
Right.
short short in the bear market, right?
Yeah.
Because then your whole mindset is messed up.
Right.
But yes, would be really interesting to look at it and basically set up a long short portfolio, right? And we can simulate that. We could say, all right, those are all longs, those are our shorts, and then you see the combined capital curve. And in general on risk, I actually like more and more I go, I did a lot of deep dive in market timing, and it's just too much work. And psychologically, if you're wrong, it's difficult.
Right.
So I said, all right, my longs do so well, why not just short the Russell 3000 against it?
Sure.
And that's actually also a good idea. So you could take your zombie list, put it into the strategy book. One strategy is short, one is long, and you see the capital curve basically. Yeah, and you already laid it out. I think you've got to be careful on the short side because if the position size is too big, because you can lose more than 100%. So, but yeah, that's a really interesting approach. And Curtis, you got great shorting strategies. Yeah, much better than my ones. Yeah.
Well, it was a lot in the liquid space because for about 4 to 5 years, I did consult with a short ETF, short only. And so we did a lot of research into that. But anytime I would get into smaller stocks, like we couldn't touch anything under $1 billion. It was usually, S&P 500 stocks, at least 20 million per day turnover, like USD. So, I mean, I did find some less liquid stuff that was quite interesting, but because they wouldn't pay for any of that research, I didn't do a whole lot in the low liquid space, but I'd definitely be interested looking into it again.
Great. I think too, at the very least, just to have a sentiment score for me.
Yes,
And then maybe I can just use the Russell as my tool to short, right?
Yeah.
I think that's where I have more.
No, that's really easy. We just, we get the ticker list, put them into basically a portfolio book, and then you see the capital curve. That's really easy. Yeah.
Beautiful. And how do you guys, I mean, did you see liquidity being an issue? Because I know you have, Curtis, I was looking at some of your stuff, you have some level of liquidity you won't go down to, right? And some of the alpha we probably get here is because of we invest in low liquidity stocks.
I would say 90% of it.
Yeah, probably right. Yeah, a good part of it. Yeah,
that's the edge for it. That's the reason why my Substack is called Trading for a Sub 1 Million Account. That's just the edge is just much bigger. Yeah.
So we can still do this in low liquid stocks, and at least as a guide. Maybe we can't extract all the alpha out of it, but we know we have an opportunity to make some money.
And it so depends on the end user. Like I got a brother-in-law and he would deal with the super liquid stuff, just putting $2,000 per trade. I had one client, he wanted to run $1 million portfolio in microcaps. Actually, no, he had 100 million at one point across 100 names when I ran that two-man team with Cap IQ, and the slippage was crazy. So we end up discontinuing that. But
really, okay,
yeah, but it means it just depends on the end user. Like if they're just a guy and they want to make a $2,000 bet on some OTC stock, Who's to say they can't do it if it has a high
But
quant
I
rank?
think there is also a strategy. It really depends on turnover. So I build strategies that never sell. Basically, they just add stocks, right? So you end up having stocks that go out of business. You lose more. You lose 100% or you lose 98%, but they still worked because they had also big winners, right?
Right.
So
That's what
liquidity
you
is
win.
really a question of turnover. So if you rebalance once a year, you can put a lot of money in those, even if you would need
That's true.
4 weeks to get in there, right?
Right.
But if your holding period is long enough and you diversify, it can be huge. Yeah.
Yeah, that's where I'm struggling with the MSMQI. Is like I intended it to be no rebalancing, right? Or maybe once a
Yeah.
year. We had about 1 to
Yeah.
3 stocks a month. So it might be kind of cool. But the risk in that is when you have these drawdowns like this right now, you have we have some sharp pullbacks.
Yeah.
For two reasons. One, because we're investing in these really inflection point stocks, and they're the biggest. If they're the biggest, we had a really huge outperformance. They're going to fall the hardest in the market pullback too, probably because they're so high and the charts are crazy. And of course, the ones that shouldn't have been put in the index will matriculate to zero over time because they shouldn't have been there. And these market resets are when all that happens at the same time. So what I'm trying to give members here, okay, we're going to keep that index going I want to keep that bias check. But I feel let's give them another option where we're still trying to, reduce that volatility and keep some alpha. And that's where I think you guys are going to be able to come in here. So we'll have these going side by side kind of thing. And I have a lot more bigger ideas too. If this works out, will be how we can continue to dissect the index to make it more useful, because this is just going to grow and grow. It's 100 index now, but it's going to be 500 one day. So
Nice.
there's going to be a lot more we can do with it, I think, as we're going around. And I really want to understand. I have a contrarian strategy going because I like our buy and pullback portfolio, have momentum going, buy and pullback portfolios going. So it should be a lot of fun. And really looking forward to this hopefully working out for us here. And did I miss anything?
No.
Okay. All right, well, thanks, Andreas. Thanks, Curtis, for doing this. Two quant investors on, you'll be seeing a lot more of us we'll do a lot more of these videos in the future. I think I really like to show, I know, Curtis, you showed me some of your back testing stuff. I'd like to come back, maybe and show people what you could have done for our index, right? I want to see how it could have been, what we could have done with it. And Curtis, you have that already done. I don't know if you guys want to talk more about that before we do that.
Yeah.
Maybe show like what this would have done and back testing it, and to show how impressive. I mean, what you showed me already was really impressive, Curtis. And I think also I should say, hey, wait a second, we want to talk about AI here real quick. This is big time. I'm trying to use AI whatever I can here. It's driving me crazy. So maybe Curtis told me that you're working on using AI to help you, maybe with what you're doing. Maybe you can get into that a little bit.
Yes. So basically the workflow is pretty straightforward. You select a target, the AI, the machine learning is machine learning, basically machine learning algos should optimize against, right? So you would say the machine learning, all right, optimize against 3 months total return. So 3 months total return, for example, works very well with small caps because they have those, faster moves than big caps. A big cap model on the S&P 500 might need 12-month relative return as a target. And then the second step is basically you give the machine learning a ton of features, right? So my best feature selection was basically, we have about 1,000 features or meaning factors, right? We have about 1,000 factors. I went through all of them. And I just intuitively said, all right, this is a good factor, this is not a good factor. It's like a 2-second decision, 3-second decision. And so at the end, I had 103 factors. And then you basically say, all right, you say, how is it tested, right? So how is it trained? So it looks at looks at the factors now, at the features now, goes with the 3-month relative return, goes in 3 months into the future, looks back which feature combination aka ranking system has the best performance, and is training that from usually training from 2003 to 2019. So it's training and training and training and doing all those combination, and you select basically different machine learning models, usually on small caps, light GBM. It's called light GBM. It's doing the best. You can ask ChatGPT why. It's doing very well with sparse data. Obviously, Microcap have sparse data. It's non-linear, so it's capturing non-linearity. That's exactly what we want. We want to go to the right side of the distribution, of the fundamentals, also on price-based factors. And then you train those machine learning models. Let's say you pick 10 different machine learning models. We have them out of the box. They are doing a good, they're out of the box machine learning. They're doing a good job. We scanned like 25 papers, looked like, okay, which papers are using which machine learning, and kind of build a standard out of it. But you can also tune them. You could say, all right, those are the hyperparameters of a machine learning. And then I go to ChatGPT, and it's really doing a good job. I mean, it's not that I crank out a ton of more performance, but sometimes it gets a little bit better. And then you look at then it trains, and then it takes basically, so to say, the machine learning ranking system and makes a pause and makes an out of sample test. So let's say you said rebalance every week, then it builds a portfolio basically from, I don't know, 2022 today, basically. And then you see which machine learning is doing the best. Then the next step would be build a predictor of the best machine learning models, and we train it from 2003 to 2019, and then do the out of sample test, right? So what's really important is that you don't mix up training time with the out of sample test, right? You have to stop the training, make a pause, you don't have any spillovers, and then basically do the out of sample test, right? So that's in general how it works. So the learnings are, you need different machine learning algos on big caps than on small caps. You need different targets. The secret sauce is really the features you give it to, the machine learning, right? Actually, I took your ranking system. So first of all, absolute kudos, right? I mean, I never saw a ranking system. The ranking system came from you, right? I never saw a ranking in I mean, it was kind of the first draft, right? It's not, we're not doing this since 2 years or so. It was kind of the first thing, right? I never saw a ranking system that strong from somebody just shooting us ideas. I mean, right. That's really great, right?
And we got a good start.
Yeah, so we tested it traditionally, right? Or Curtis tested it and traditional way, and I took it and put it to AI and it did really well. It did really well. So that's basically what it's doing. And you can look at the feature importance then, basically. You can see which of those 133 features are really important, and you see a ranking of those features, but it doesn't behave like a traditional ranking system. It might do something like, okay, if the market is down, value, momentum, and quality is really important, and then this gets the highest rank. So it's dynamic, basically, right? So which makes it a little bit different. You can look at the feature importance, but you don't know 100% what it's doing in that moment. So for me, it was really important to see out of sample. So I let them run 9 months, 6 months, but the out of sample was so good that I was sucked into it, right? I said, okay, all my traditional models, they are great, but this is better. So I just put all my money into it. Though I'm hedged right now, I only have like, I don't know, 10% net exposure since a couple of weeks. Yeah. So that's AI. Yeah.
Awesome, man. Awesome. So I mean, what I'm hearing here too, though, man. We could probably use AI to start bringing in the qualitative piece of what I do.
Yes. I got so much ideas I mean, you
really
look at the
awesome.
feature importance, for example, on my small cap systems, the highest ranked feature was low volatility 6 month.
Right.
I mean, honestly, Curtis, would you have put that into a ranking system?
No,
You know, would that idea
Never.
pop up under the shower and say, "Oh, I have to test 6 months low volatility"?
never. No.
I think
and
our goal.
but at the same time, it just made click. And 3 years ago or whatever, 10 years ago, I read a paper about it, and you start to get, it's just really creative. So I don't know, I'm all over it. Don't take me serious because I the lightning just struck me, right?
I
go ahead, Chris. I'm sorry.
Oh, I just wanted to mention the thing that I do love about AI is it isn't just push a button. Like all the things that are important to you, Maj, if it can be quantitatively expressed and important to me, you put them into it and it will mix and find interactions between those. So it's not just like dump a billion things into it and it just spits it out. It still is a Maj, Curtis, Andreas concept that it's just modifying and optimizing a bit.
But I think the goal here is
it won't make, if you don't have a background, it won't make you better. It's like AI in general. It makes a strong engineer, IT engineer, gets better through AI, right? So
right.
So it's in this direction. Yeah.
And here's why I think it's going to be really cool, and it's going to be, I think, gold for us is that that my team and we're sitting there doing a research and manual effort, because a lot of it until AI was manual effort, and sometimes find these things by accident. You're just reading and reading and reading.
Yeah.
But if AI can start like bringing this stuff to us in scale, it could be pretty fucking amazing. I mean, we're talking like multiples, probably where we're at right now in terms of return.
Yeah, I would still reference it for conviction. I think it's important. So when I see something, I have to say, I don't know, I design about 250 AI systems now, and I never saw something in the feature importance that didn't make sense. So it always, I don't know, S&P 500 model that said, what was the biggest one? I think it was dividend growth on the sector was the most important. That was really interesting, and it printed a low volatility kind of big cap system. I would still reference it in that triangle, right? So testing your experience, your discretionary experience, and academic papers, and just to be sure. Right?
Yes, for sure. I'm gonna give you an example how would this work. So like one of our stocks we liked a lot, or we still like a lot, and I own, by the way, is CSBR. Okay. And if we go look at I'm gonna share my screen with you now too, okay? I'm gonna share something with you here. I'm gonna show this thing that we built here, which is gonna have AI things to it here soon. This is a press release tool that we built here. So a lot of my research over the years has been always reading press releases, and it was always going to each wire individually, and I used to have a team that I would hire to basically, this is years ago, they would read the releases for me and only show me the small cap ones, and then give me their analysis on it. I stopped doing it because it was too inefficient, because you had to open up every release. There was no mechanism to really start filtering releases. So this thing here brings in stocks, market cap under 2 billion, all news releases. And we can filter. So it allows me to do my research really quick. So if you look at let's just type in, see, it's just this is covering right now US and Canada, by the way. So we bring.
I had that stock in my portfolio for a while.
CSBR.
Yeah, CSBR. Yeah, bought it at the breakout. Yeah, but sold.
You bought the breakout. Oh, great! I bought it after fucking breakout. So
the second day or so, but not very long, like 2-3 weeks or so. Yeah.
Where was it here? Was it December? I think here it was. Yeah, this. I think this is it. So the stock is what, 584. So they had earnings that day, and they were pretty good. But the key here in this the release here, I want to show you. Now this company, by the way, does the research services for biotechs and pharmaceutical companies. Cancer research. They own it. They own this. Let me cancel this. Come on. They own a is that gonna work? Let me see. Hold on one second, okay? Let me bring up this is my beta version here. Let me stop sharing here. And it was where right here. Here it is. Okay. Yeah, so when you look at this release, this is a good example of information arbitrage. So basically they yeah, so they've been doing that for years, around 40 years or so, and they have this live living cancer tissue, I guess, that they have in their bank, and they're just doing these research on, and they're helping companies with their research, original research, combining drugs together to offer, the cancer patients. And let me see here if I can find it. Okay. So this is important. This is what should have caught our eye, by the way. I didn't catch it. Someone in my network, was like, well, hey, Ma, you need to look at this. And it was this sentence here. So in addition to our core business, which is the old legacy business, which I know well from the past, which is a 10% grower a year, I just know this. We made significant strides in monetizing our data platform, establishing an additional revenue stream that can be transformative for the company. So that basically is okay. Dad, what does that friggin' mean? All right. And there's also been there was some verbiage here about the industry just getting better in general, because it was in a 2-year. So a lot of the funding environment for biotechs determines how much money will come into these companies, right? And that got hurt during the pandemic, and then 22 a little bit. So that's the first step. Okay, boom. That's a clue. And so our AI thing we're building is gonna find that, or we can use ChatGPT to find that kind of stuff. But we find that information, right? All right, what's the next step? So the next step is then to go to the conference call transcript. And to me, why my juices got going there was because I know data is a very high margin business. I think what does that really mean? Are they going to sell data? Because they've been around for such a long time.
Yeah.
That might mean, okay, well, that's pretty cool. Remember, the stock was at 584 then, right? So if we go here, seek an alpha. So this is the transcript to that call, right? And you start to see here with the raise of AI and its ability to unlock deeper.
Okay.
Here it is, right? So wow, okay, this is a new thing. In the coming quarter, we expect to introduce a new stream through data licensing, which to me is 95% gross margins probably. They're taking all the data
Yes,
for 30 years now.
Yeah.
It's all that. And then what happened when you went to, I'm not going to share my screen. There's a section in this SEC documents called subsequent events. And in that section, and every SEC document has it, it's other 10Ks and 10Qs, it talks about if there were any significant developments between when the quarter ended and you released your Q. All right. So
you found something more. Great.
So it's like, okay. And then the 10Q was released the same basically day. And this, by the way, this is my friend telling me the sequence of how he found the stock, invested in it at that time, and then I ended up probably buying it in the 7s after digging into this. We wrote it up on Geo too, and my Substack. We added it to the index. So in that particular section, usually it's like the question is, were there any subsequent events, blah blah blah, and the usual boilerplate answer is no, there was nothing there. Now look, the company could put a press release out if they wanted to. Right, but you can also just bury it in there and you comply with disclosures. You don't have to put a release out. So, and we go there and they got their first $5 million contract.
Wow.
So that's information arbitrage alert 101.
Yeah.
If I would have seen that I would have bought the heck out of it at $5, right? So that's where AI can help us. And so we have this AI score, boom, we have information arbitrage. The tough part about AI is how do we score it? It's not just, it's also enough to know they have a $5 million contract. You need to understand that it's 90% margins potentially, and it could be this much EPS. But you found a golden nugget that was not in a press release buried somewhere that we know is significant. So it has, it's a score, like that's significant. And then the stock went to what, $11 over. It wasn't a slow, but it was slow enough to get in. Where as an
Yes.
active investor, you could have got a big edge there. Of course, then we would take that information out. The way I would see it happening is take that information, assign some kind of valuation to the stock now based on that, what that EPS would be on that potentially, and we would feed that to everybody. Now, of course, stock now is you know, it's pulled back. It's back in the 8s, 9s here. But if they hit, and they came out, by the way, in the next quarter and did a huge quarter, but everyone knew about it by the time it came out, so it actually went down in the news, and the market was kind of fading. But if they start getting 3 or 4 more of these things, now you have a 10 bagger on your hands probably, because you have this crazy high margin business and everything in the. And if you go to the next conference call transcript, which they're even talking more about it, getting deeper and deeper into like how many customers might be there and then what the market looks like. So you're seeing a potential for the pessimistic investors are going to say, well, I got one, they're not going to get any more, right? The optimistic investor and AI is telling us they're going to get more. It's higher probability they're going to get more of these. Yeah, that's one example. The problem with this whole thing is that it's so this aggregated information is out there, but it's different information. It's not always going to happen in the same fashion, right? I mean, how many times is it going to happen? There's situations, for example, in the 13D filings, which basically show you a big shareholder coming and taking a big 5% position. There's a section in there called purpose of transaction. That's boilerplate. Yeah, we invested it for investment purposes. But sometimes you get this, you know, this event where, yeah, because we offered to buy the company. They haven't said yes, yeah, we offered the company, want to buy the company, and the stock's still sitting there. That would be an info alert where you have this non-boilerplate stuff in there that you would have had to go in there. So I think the opportunities are endless how we could build this. But the challenge will be, how do we score that information?
Yes.
To something here. And it all depends. It all ties back to valuation. What does that information mean in terms of the valuation of the company? But there is a lot of info arb in conference call transcripts. It's not in releases, but that's just okay. Sentiment that's maybe positive, but there's a lot of bullshit in conference calls also.
Yeah, absolutely.
And that's where it becomes really difficult to score that stuff.
Yeah.
Can I just
I mean,
share?
maybe we can. Yeah, I'm sorry, Curtis, go on.
You go first.
No, you go first.
I was going to show a chart, so go ahead.
No, go.
You want to show the chart? Okay.
Go on.
I just wanted to show
Yeah.
the Maj ranking thing, because I think that you could start with qualitative, like you have an idea, you read something, you found it in AI, and then you can go to the quant rank. One doesn't have to, like, either one can come first. So I'll just share, and there are some clues that it might have been like a strong stock. For example, as the price is going up, the ranking system is dropping. So you've already got a clue. Something's not adding up here. There's that around the press release. So there's a big spike. I mean, it's still, the ranking's only at 65, but you got a massive spike. Like it went up, the improvement, and you're talking right here when price is just sitting, you know, sub 5. But what's really interesting is even as the price is declining and going back down to the $4 or $5, now it's hitting some of the highest ranking ever, like 95, 97.5. It's hitting like absolute top. And that's all before this massive spike from $5 to $12. Of interest, it still is high ranked even though the price is dropping. So I just think, you know, when you mix the two, and I don't know that you can 100% encode that into a quantitative system. I think merging them together with the brain of you and Andreas, that's...
What's nice here, you're showing me here that actually this would have ranked higher before this news hit, actually, too. Because the news hit in December 24. You know, I could have been building a position well before that, you know.
What year?
It was December 24, right there, December 24, right?
Oh, 2024? Oh, I assumed it was back in 2023. That's why
no, so you're right. You're building it. You're building it all over here.
Oh yeah, no, this thing was ranking crazy high before the release come out. So
yeah, which is perfect because I want to get in before that, right? If I can.
Yeah.
Sorry, Andreas.
No. I mean, basically what you said. I think we can turn it on the top, right? If So what I'm seeing in our research is basically breakout stocks on small caps are usually doing really badly, right? So because the problem is you might get one of those zombie companies, right? They go like this and then they go like this until they go to zero, basically.
Right.
But if you have a stock that we just saw, a stock that ranks with 99, and that breaks out, you got something. You got
Right.
absolutely something. Those are the. I mean, I would say that I would say 50% of my. You don't get much of those. You get maybe 5, 6, maybe 10 a year, right?
Right.
But I would say it's 50% of my return in my trading, right?
Okay.
And if I would have more guts, I would add to the position actually, but I just let it systematic. But if you see something like that, you see a flat base, you see a highly ranked stock, maybe we turn it around, right? Because you have time. You have time. If you see that high ranked base breakout, you have a daytime, right? If you have a research team and then dig into it, and you find then something, then size up. That might be, I would not. You are so strong discretionary, right? All that quantitative thing and all that II thing, it's all good, but I think it should be just a base in terms of seeing, right? Base, and then you have the highest ranking possible with your ranking system. Now price spikes, and actually, I don't go in there. Even I would not go in there at the first day because it's absolutely quality if the price spikes and stays high and doesn't retrace a lot, then something is going on. And in those small caps, you got days to get in there, right? At
Right.
least in the second day you can get in here. So you get 24 hours basically. No, not really. It closes in the evening, But if you got a research team, you see it's highly ranked, and then you go basically through the scripts, right? And you see that what you're seeing, then load up. I think that's the best strategy. So let the AI and the ranking system tell you in which situation you are, and then add the discretionary stuff to it. I mean, my intuition says that's hard, very hard to beat. And actually, a lot of small cap breakout traders do exactly that. Just be careful trading breakouts on low ranked stocks.
Right.
That's a disaster. Yeah.
Is that
And
right?
wait for
Okay.
the second day, basically.
Okay.
Yeah.
That's good to know. And that can help a lot with trading. We're looking for a trading setup. It might look interesting for the naked eye, but if it's not ranked high on your system, you don't enter it.
Yeah,
Right.
exactly. Yeah.
And what I might be cool too though is like if my InfoArb monitor is bringing all these stocks in, you guys just rank those too, right? You could rank
that
those
would be
for us.
great. Yes.
That would be really awesome.
I would even, be interested in putting some money into there of my
Okay,
portfolio.
cool.
Yeah, I'm going to
We have the
subscribe to
whole
you.
we have the library we're building, so I think we can have some fun with that for sure.
Excellent.
Cool, man. All right, well, I think that's good. We think we can end it here. We can have a lot to chew on, and we'll do this. Let me just reorganize my thoughts here and get some stuff done, and we regroup and start getting this thing going. This is great.
Fantastic. Thank you, Maj.
Yep. Thank you.
Thanks
Thank
for
you,
your time,
Maj.
Andreas, too. Yeah.
Yeah. How big is your team? I mean, you got an assistant and everything. It's just like crazy.
we got a bunch of. It's pretty big.
Yeah.
We got like
Nice.
7, 8. I think we have 7, 8 guys, people on the team now. That are helping.
They're all analysts basically, or
we all was probably there's basically 2 analysts. And then then we got a lot of I call researchers. We all wear the hat of research. So anywhere from
Nice.
if you're just doing the admin stuff, if you're doing editing, they all have to be aware of what we do here, so we can all contribute to like stock picking. And I'm a big believer that anybody can do stock. Well, not anybody, but you don't got to be a financial expert to do stock picking. You just have to understand trends, understand valuation, and just common sense valuation and common sense, business models. And that's why I require that everybody on our team reads press releases. I actually teach kids younger kids how to have a class. I don't really market it. It's a class. I would do one-on-ones, and I prefer these really bigger intermediate kids because they're open-minded to reading releases and doing the grunt work. And I really believe in doing the grunt work in the beginning of a career to start understanding management speak and when you're getting the bullshit. I'm a big believer in qualitative.
Yeah.
And because to me, like the quantitative helps me, okay, get to a level of conviction where this is undervalued. The qualitative gets me to, I can take a really big fucking bet here because I believe this is going to be going to be very well quantitatively. Yeah. And I think combining these two factors, the way I kind of start seeing this is like, okay, we're going to using your ranking system, have this diversified kind of thing, and then slowly building conviction on some stocks as information flow comes in to make us. Can you pull up before you do go, man? Can you pull up TSSI, you guys? I'm curious to see if we look at the last. That was our biggest winner, and I want to see when this ranked nicely. Okay, look at that.
Oh, it started shooting up back in like September 2023.
Yeah.
And then it really got high, like crazy high here, right? Like what is that? June, late May, early June is when it just peaked right here.
Right.
So right around, what is that? Like $2. And it did dip though, so I don't know. Like something, I'd have to look what happened here.
Where was the last time? Was it 50? Wasn't it 50 cents sometime in August of 2000?
Yeah, I'm having a hard time looking that low.
It's going up so much.
Yeah, I think
all right.
Then it spikes back up right here before it goes up.
Oh, that's what it was. Was the third quarter? So it was basically, when was it 50 cents last? I think you're right about what, Mayish, March, right there, yeah.
Right
So
in here.
right in there, there's the info arb. The info arb there was, well, the CEO was buying stock before that a little bit, but right where your arrow is there, Curtis, is that on their conference call, this is they do data center, AI integration or rack integration for data centers. And AI was a big part of where they were going. So in that conference call, I think it was their fourth quarter conference call, or maybe it was their first, I forget. They mentioned that they were actually probably a Q1 conference call. They mentioned that they are now in a position to 10x their capacity, and they're going to be profitable. And then then there was a change of verbiage in the 10Q filing and maybe 10K from we're going to be profitable to we're going to be profitable every quarter from moving forward.
Wow.
So between those two things, and you could have sat there for 2 weeks, maybe more, buying at 50 cents ahead of the breakout that was being telegraphed by the 10X comment, right? And then, of course, AI took it like crazy.
Yeah.
That's another example of, but what I like about what you showed me there, Curtis, was that it was still highly ranked even before.
Oh, yeah.
And that was really surprising to me because it didn't look, you could not have looked at the fundamentals back then and thought that this was going to be great. And so your model is predicting this with that, which is great. You know, that did that.
I like to say it creates the environment. It's not that every stock like that's going to run, but I like that it's a fertile field. So when there is a trigger, boom, now you've got rocket fuel. But you might have to wait. I mean, it took what, like a year or so.
Sure. What I like about that though is since I'm already bringing stocks into the funnel that I really like, I already have some degree of confidence.
Right.
So I can maybe, if I can start getting comfortable with, okay, well, it's not moving, but it's ranked high. All right. Let's start tracking that and seeing how that works over time. And it becomes a conviction builder. Yeah. But yeah.
No, I think that's really the way. I mean, everybody has limited resources, right? So if you would concentrate on that highly ranked stocks that didn't break out, you concentrate your research there, and then maybe buy early, right? And then by this, the breakout comes, you do the 24-hour research, and then you buy more. I think that can be, I think you can have a really concentrated portfolio doing it this way and save yourself a lot of time, basically. Yeah. Wow. And I would be really interested in getting into a loop here and putting some money in it too.
Awesome. I'm actually, I guess my next step will be, I don't know, Zoo, you still here, Zoo? On the call? My brother. Yeah, my Zoo, he's been digging into AI a lot, so he'd be someone you'll be talking to a lot here, I think, and we move forward and helping us develop this project together. So,
Maj, what I hear Andreas saying is use Quant, but don't be swung over to our camp and use it fully. Like
no,
Yeah.
the combination
what you've got going on is fantastic.
It's much stronger. Yes.
Yeah. So just use it to supplement. Yeah.
I think where I would just like help managing the risk, managing when a stock maybe isn't ranked high, just to have that information, you know. And
yes,
I think like how could I present, like the index, for example, was down, you know, significantly in this downturn. But when I look what Curtis showed me was it would have been down a lot less using his thing.
yes.
So
yes,
more in line with the market, or maybe even a little better.
yeah, yeah.
So that's what I'm trying to get out of this thing, you know. And I think it works better for my subscribers too at Geo and the Cliff Note to give them some of them maybe don't want to ride that volatility. You know. And what the other big part about this, guys, is we have 110 stocks. It's going to be more. These guys, no one's going to be able. Most people aren't going to be able to buy that many stocks. So by taking what you guys do to make it more consumable for them will be better too. I think that's a lot of it too. Cool, man. All right. Well, I think that's a wrap.
Okay.
Yeah. Thank you.
Thanks, guys. And
Thank you so much.
we'll be in touch soon. Okay.
Sounds good.